Welcome back, everyone, for another episode of the Crossroads. So today you're joined by myself, Thomas Kopelman, and then Trayton DeVore. Today's topic, let's get right into it. We are going to be talking about how this is not our parents' market. So Trayton, kind of let's start talking about like what really makes this different than, maybe the market that our parents grew up and got used to.
Yeah, so I mean, if you paid attention to kind of anything that's happened over the past year, like everything with GameStop and Reddit and everything going on with crypto, like first there's just a lot of new things that weren't around back when our parents were younger and our age. And it's just, you just kind of have to approach everything differently, which is what we're going to dive into. But things like our parents couldn't just hop on a cell phone and download Robinhood, link their bank account, and get in the stock market. Like, we've never had the access that we have right now, which is both a good and bad thing. Good from the fact that being able to invest is a lot more accessible, but bad because it's a lot more accessible and you don't necessarily have to really know anything to get in. You could download Robinhood, put 10,000 in, and not really have any direction or knowledge on what to do with that money. You can just really invest it in whatever you decide to buy, which is a good thing. But if you're not educated around it, it can turn bad really quick.
I was just going to add, I think that is like one of the biggest differentiating factors. If you think about it, like 30 years ago, like our parents are in their 20s or 30s. Like if you're going to trade a stock, you're calling your stockbroker, you're calling your financial advisor and saying, here's really what I want to do. But today it's completely different. So like, if you really think about what can drive some forces of the market, it's if you like young people are investing, like we hear stories of 14 and 15-year-olds buying on margin, buying GameStop, buying cryptocurrencies. And not necessarily saying that there's anything wrong with that. There could be, but I'm just trying to make the point necessarily that like that can truly drive the market to respond differently when everybody can just go in and do whatever they want whenever they want.
Exactly. And kind of to add to that point, like what happened with the Reddit and GameStop situation, like that would have never even been possible 20, 30 years ago, because what happened was a group of people on the internet on Reddit got together. They saw that there were like bad positions on GameStop, so they decided to short squeeze all the hedge funds. And that was only possible because of the internet. You could get so many people on the same page to all do the same actions at the same time, and that's just never been possible before. So there's a whole lot of variables and things that are just different now. And I think like one of the first things to kind of just figure out how to approach this style of investing and just the stock market in general is to listen to trusted sources for information, and also fact check that information yourself. Like, we're not limited to turning on the radio or turning on cable TV and listening to the same 5 to 10 different channels. Like, we can get on TikTok and get financial advice from a 10-year-old, or you could get on YouTube and get financial advice from the best investors in the world. Like, there is just so much information out there that you just have to be careful and actually understand who's providing that information. And one of the biggest things I always think about is like, what's the motive of that person giving the information? Like, aside from the stock market, like if a real estate agent was going to tell you, yes, buying a home is better than renting, well, they're obviously going to say that because if they buy a home, or if you buy a home with them, they're going to get a commission check, they're happy, whatever. And it's like, if someone, I mean, not that anyone from GameStop was pumping the stock or anything, but you just have to understand like where the information's coming from. And after you get that information, it doesn't hurt to do like a quick Google search and do a little more research on it and figure out if that information is actually true, or if there's a different side of the story, and just like get a bigger perspective around information before making investing decisions, for sure.
Yeah, I think you made an important point there of like, again, 20, 30 years ago, information didn't spread as quickly as it does now. So like you're hearing it maybe on the news or something like that. Now it's like the second something happens, we hear about it on Twitter or wherever it is. But I also think you made another great point of like, validating your sources. And I think we have this big problem where because somebody is successful and somebody is smart, we listen to their investment advice. That could be true. It could not be true. Just because Elon Musk says he believes in Bitcoin or Dogecoin or like whatever it is, doesn't necessarily mean that that's right. That could just be his individual belief. And somebody else, down the street who has 300 Twitter followers might know way more about these cryptocurrencies than Musk. I'm going to say that's probably not true in this situation, but I'm just trying to help compare that. Like, you don't really know. And we just see people who are successful, people who have a lot of money, and automatically assume that whatever investments they make or whatever they do is the right decision. But that isn't necessarily true for us because, for Mark Cuban to go put, $10 million into Bitcoin might be 0.01% of his net worth versus you now go say, hey, I need to try to get involved. And then you put 100% of your net worth into one investment. Totally changes the output and how you can handle the investments.
Exactly. And that Elon Musk example leads us into the next one perfect, because the next point I had was get to the root of the happenings. Like, what is going on? What is causing whatever's happening at the time? Because I mean, as I'm sure you've probably seen throughout the past year and a half, like Elon can tweet one thing about Bitcoin and send it down 20%, going up 20%, either way. And I mean, I personally think it's crazy that just like a tweet from one person can like make an asset class go up and down by several percent. But if you kind of understood that the market was swinging because of that tweet, you're probably not going to sell because the tweet doesn't have like actual impact on what's going on with that asset. But at the same time, it's like if Warren Buffett said something like, yeah, Coke is terrible for the environment, it does this, this, and this, like people are probably going to sell off their stocks too. But that doesn't mean you should just because Warren Buffett said it. Like whatever he said might not be true. Like the story could have been reported wrong. And it always just goes back to like really do your research before making a decision. Like, yeah, you can listen to the information, you can take it in, take it as you please. But if you're going to make an actual investing decision that affects your money, like you got to do research on both sides of the table. Even if it's a good thing, it's like if Elon's like, yeah, Bitcoin's going to hit 100,000 for sure this year. Like, what? There's no validity to that. Like a lot of people have said it, and it might be true, but you can't just base a decision off that without doing any research backing up. Like, why could it go to 100,000 or whatever it is? Like, just always have to do research for sure.
Yeah, no, really, really good point. I think the last point that I really want to hit on is just like how the last couple of years have changed people's perception of investing. And so I know, like, if you think about the history of, the stock market, the average returns, somewhere 8 to 10%, depending if you take in inflation, which is what people have become accustomed to get. But now over the last few years, like we're talking to young people all the time that are like, oh my gosh, like, I only made 200% last year in crypto or something else like that. And people are starting to get accustomed to these like really crazy returns. Or even if you just look at the stock market, like a diversified portfolio, like the last 10 years or pretty much the entire time millennials have been investing, the market has been good. We haven't really seen any true recessions over this time. And so people are starting to think, well, I can always put money in, it's always going to go up and to the right. And while we've come we're able to realize that over the long term, that might be true, but over the short term, that isn't true. So you don't really want to be investing money you need in the short term in some of these volatile things. But I do really want to come full circle because like I had a client who, invested in Bitcoin, things were going kind of well. We went to review their portfolio and they're like, oh my gosh, it's worth 7,000. It was at 6,000. And you're like, yeah, like think about what that return is. Like, that's like a, 15% return or whatever the number might be. It wasn't exactly 7,000. And they're like, oh. And so I think sometimes people have to take a step back and realize like when you have small amounts of money, it's not going to go from 6,000 to 12,000 in a year. That is not normal to be doubling your money. And we've seen all these TikTok videos and stuff. They're like, hey, if you just do this simple approach, you will double your money every 10 days. And then you come to realize like, if that was true, you'd have like $100 trillion by the time you retire. Like the market
Yeah,
doesn't work like that.
they wouldn't be making TikTok videos if they're doubling their money every 10 days.
Exactly. Exactly. So I think it's just like we all need to take a step back, be a little bit more realistic, understand there might be, recessions and there might be downturns in the market. Crypto might go into bear markets. Like all of these things are probably going to happen during your investing career. And so get used to it, continue to stay invested, and just understand those things are going to happen, because a lot of people don't. And then when they do, they're going to panic because they've put all of their money into all their eggs into one basket, and they're kind of going to end up stuck.
Yeah, and I think that's a really good point. And to add to it, because I mean, if you're trying to get 200% returns or something crazy, like there has to be a trade-off in that equation, and that trade-off is risk. And a lot of people don't have the ability. They might like emotionally be able to take on the risk, but like financially not be able to take on the risk to potentially get those 200% returns. One, because those returns are never, ever, ever guaranteed.
Yeah.
And to make a significant amount of money, you also have to put in a decent amount of money in the first place. And it's like, if you don't have, which kind of leads us into the next point of earning the right to invest in fun things, like you need to get your financial foundation taken care of before adding additional risk to your money, like things like having a fully funded emergency fund, having the proper insurance coverage, not being in debt, like sufficiently funding retirement accounts. Like there's a lot that needs to be done before taking on a lot of risk that comes with trying to beat the market by an exponential amount. Like 100% is still crazy. 50% is still kind of crazy.
Yeah.
And people are getting like 1,000, 2,000% returns in crypto, but they're also taking the risk that that's going to go to zero. 100%. Like you never know.
Yeah. I mean, you made a lot of really good points there. I think that the one point that you made about, they might be able to stomach the volatility, but they don't know if financially they can, is a really good point. But also I do want to use this as kind of like a disclaimer that like, it is one thing to do a risk tolerance questionnaire and say, like, if I had $100,000 and it went down to 80, I'd be fine. Or if it went down to 60, like I would trust it. But then when that feeling actually happens to you and that hard-earned money of $100,000 you put in the market is now 60, it doesn't necessarily mean that you're going to be able to stomach it when it really happens in real life. Like the software is one thing, but actually feeling the emotional toll of losing that kind of money, which again, I know it's not technically lost until you sell, but just feeling your money go down is something that a lot of people prepare for. They think they can handle, they get there, they know what the research says, and then they just sell, and they set themselves up because they took on more risk than they truly could handle.
Exactly. Like when it's real, it is just a whole different feeling than just kind of pontificating and thinking about, oh yeah, if I put in 50,000 and it went to 100, that would be great. But if it went to 25, it wouldn't be the worst thing. Like if you're putting your hard-earned money that you have to go to your job and earn, and then you see that money going down by 50, 25%, whatever, like it's just a whole different feeling that you can't really even describe until you've seen it happen. Like I haven't had a significant drop like that before, but I've put money into something, it went down. I'm like, oh shit, like that doesn't feel good. Like, why would I do that? And it wasn't even like anything crazy risky. Like it was just normal, because I mean, there's risk in any investing, and especially in things when you're trying to beat the market, like crypto or meme stocks or anything you're trying to get abnormal returns. Like you're just taking on risk with that.
Exactly. Okay, that was an awesome topic for today. So now we're going to get into the reader submitted question. And the one that came in this week is, should I do Roth versus traditional? Which is honestly like a really common topic that we talk about with clients, and that just people are always asking about, because it really is trying to answer the question of, do I pay tax today or do I defer tax today? And what most people think is they say, I would rather pay the least amount of tax this year. But true good tax planning is about, how do I minimize taxes over my lifetime? And so when you look, let's say somebody makes $100,000 and they could put $6,000 in a traditional IRA or $6,000 in a Roth IRA. Well, if you do the traditional, your taxable income is now $94,000. And so in reality, that saves you probably like $1,500 to $2,500 on taxes just by that little reduction depending on where you're at tax wise. So that feels really, really, really good. But then that money is going to grow. You're going to get to retirement and you're going to have to pay tax on the larger balance. So the thing that we want people to think through is, do I think my taxes are going to go up in the future? And do I think the government's going to raise taxes in the future? If the answer to those are yes, and I think taxes are going to be higher, then I would much rather pay tax today at a lower tax rate. But on the flip side, if you're somebody, maybe you're in your 40s or 50s, you're making $400,000 or $500,000 a year, you've never made any more money, and you think in retirement you'll go down to a lower tax bracket. Well, then you start to get to the point where I'd rather defer the taxes today, pay them later on in the future when I'm going to be at a lower tax bracket. So I think when you review and think and view them, there's always the top people you'd rather defer the taxes. If you're the lower end of the people, you'd rather pay tax today. And then there's kind of that middle ground where it doesn't truly make that big of a difference unless future taxes drastically change.
Yeah, exactly. And I mean, the nice thing is that the traditional and the Roth aren't your only retirement account options.
Yeah.
Like if you're contributing to your 401k through your work, you can still contribute to a Roth IRA outside of that, and you'll have tax advantaged money on both ends of the spectrum.
So you can diversify kind of. You can have some pre-tax, some post-tax. And what most people don't know is that the money that goes into the IRA or the match or the 401k of the match, whether you do traditional or Roth, the employer's match is always pre-tax. So not that that's going to lower your taxes today, but that gives you a little bit of diversification, because in retirement, you can, year by year, take money from Roth, take money from traditional as taxes change. Sure, you're always going to have RMDs on the traditional side, but it gives you a little bit of optionality as the tax climate changes.
Exactly. And one thing I want to add that I actually just saw a tweet the other day from it. And one of the articles that I was featured in, like I talked about this exact situation. It was someone who had opened a Roth IRA, linked their bank account, I think they put like 2,000 in it or something. And they came to me like a couple months after they did it. And this was even before I was a financial advisor. They were like, yeah, I opened my Roth IRA. I think I did everything right, but nothing's changed. Like it still just says that there's 2,000 in there. And I was like, that's odd. Like, let's
think it'd be higher or lower.
Yeah, exactly. And they were like, or they showed it to me, and they had deposited the money, but they didn't make an investment after the fact. So that's just one thing that you need to keep in mind if you haven't opened a Roth IRA yet, or if you have and the account balance hasn't changed, like it probably needs to be invested into something. And that could either be individual stocks, ETFs, mutual funds, really anything to your preference. But after you put money in, like it still needs to be invested after the fact to make sure you're getting the growth and the money's actually in the market.
Yeah, no, that's a really, really good point. I actually was going to hit on that, but forgot, is that the Roth IRA or the 401k or the traditional IRA or the HSA, they're just vehicles, and they're not investments. They're just vehicles the investments can go into. And based on those different types of vehicles is really how the tax treatment happens. So great thing to know. Yes, if you're going to put money in there, you still have to go in and invest it. Otherwise, you just have a Roth IRA sitting in cash, which at the end of the day doesn't really give you much of a benefit at all. So
it's like a savings account at that point. It's probably not even earning interest either. So it's like, it's actually probably the worst thing you can do with your money.
Unless they put in a money market fund, I guess it gets a tiny bit, but in the day, that's probably not how it's going to go. So that was all that we really wanted to cover today. So thanks everybody for joining us. Again, subscribe to our channel, subscribe to the podcast, give us some reviews, and tune back in next week.